Well, good afternoon. Welcome to today's webinar. I appreciate you coming out and spending some time out of your day to come check us out. My name is Devin Eckberg. I am the Chief Learning Officer and Managing Director of Professional Development for the Investments and Wealth Institute. And once again, welcome to today's session. It's really designed, what I'd like to ultimately get out of today's session is really answer some questions and give some information about the CPWA, Certified Private Wealth Advisor certification, and whether you're deciding to pursue the credential or maybe now or in the future as part of your career path. Hopefully this will provide some information for you on why we think this certification is an important one. I've also got some really good research here, so even if you don't decide to pursue the certification yourself, or if it's not part of what your goals are, hopefully some of this research will be helpful for you, that you can walk away with and incorporate into your practice today. So that's kind of my goal. I'm also happy to answer any questions or concerns. So you'll notice in your webinar dashboard, there are two panels open. There's a question panel that you can send to me or to some of the other staff that we have attending this session. There's also a little chat window. I'm monitoring both of those, and so if you have any questions or concerns, you can go ahead and put them up there, and I'll do my best to answer those questions. So without further ado, I'm just going to go ahead and kind of get started. Now, if you're not familiar with the Investments and Wealth Institute, we've been around for a long time. We were formerly known as IMCA, the Investment Management Consultants Association. We changed our name about 2 years ago because we found that a lot of our membership was comprised perhaps of people like you, like advisors, that deal with individuals rather than institutions in a consulting relationship. So the need for advice out there is tremendously high, especially in areas like high net worth planning, retirement planning, owners of closely held businesses, things like that. There really just aren't enough certified, competent advisors to deal with that space. And so as we changed our name and we changed our membership a little bit, that's partially the reason why we are offering these credentials. And so we're a professional association. We're an advanced education provider and a certification board. And we're best known for the three certifications that we administer. The CIMA, that's one that's been around for a long time, the Certified Investment Management Analyst. Many of you probably hold that credential. The Certified Private Wealth Advisor, CPWA, that's the one we're talking about today. And then we've also acquired a new one about 2 years ago as well called the Retirement Management Advisor. And all three of these are just world-class certifications. They each serve a different need. For the CPWA program, this is really designed for high net worth and ultra high net worth type individuals, and you'll see why here in just a second. So here's some of the research that I was telling you about. We conducted a research project with a researcher based in Canada. Her name is Julie Littlechild from Absolute Engagement. And we found out a lot about the preferences of high net worth clients, ultra high net worth clients. And these are ones who have an advisory relationship today with a financial advisor. We really wanted to understand, what their thinking was of why they chose the advisors that they chose, what services they expected to receive from those advisors, and ultimately what they were looking to get out of those relationships. So this research is great. It's available on our website as well, and I'm happy to share it with you if you want to reach out to me and have any questions. So the first thing that stood out to me in this research was that 92% of high net worth clients were loyal to their advisor. That's awesome. And 95% of high net worth clients are satisfied with their advisors. Now, if you look at those numbers, that's actually pretty overwhelming. So overwhelmingly, clients like their advisors when asked if they're satisfied and if they're loyal. That's actually really good news for you, by the way, because we're not seeing that flight of clients from one advisor to another that you sometimes hear about. But it does actually cause a little bit of an issue for you, right? Because how do you actually differentiate yourself between other advisors when clients are overwhelmingly loyal and satisfied with the advisors that they have? That's actually a pretty interesting question. And so you actually have to dig in deeper to this research to really find in what ways are these clients satisfied with their advisors and in what ways are they not? Where are the satisfaction gaps that are occurring? And you as an advisor, if you're looking to stand out and differentiate yourself, you really ought to be able to serve and align your services with what those clients need and value, if that makes sense. So it really just kind of starts with understanding what do these high net worth clients actually value when we ask them about their relationships. So first of all, what matters most to clients, these are probably things that are not going to surprise you. They say, hey, I want my advisor to have high ethical standards. That makes sense. And those are a lot of discussions that you're seeing right now with fiduciary rules and things like that. They want their advisors to be trustworthy, knowledgeable, comfortable. They want to be comfortable in themselves with the level of risk in their plan and their portfolio and understand what the plan is. They want their advisors to fully understand holistically or comprehensively what their financial needs are, not just from an investment management perspective. And then ultimately, of course, long-term investment performance and returns are always going to be a part of that equation. And that's frankly part of the reason you probably got into this business in the first place to do. So that's not necessarily, a big surprise to most of you there, but it definitely matters to clients, and specifically how they define things like, well, how do you define an advisor being ethical or trustworthy or knowledgeable for that matter? How are they even measuring some of those things? Where we started to see some of the satisfaction gaps kind of come into play was, specifically around things like investment performance and returns, right? So they say that, 60% of them would say that they were satisfied, but 75% of them would say that that's, the most important thing to them. So there's a little bit of a gap there between what they think is important versus how they perceive their advisors filling those needs. The other question is, well, I receive high value relative to the fees that I pay for my advisor. There's gaps there as well, about a 14% gap there. Or I'm comfortable with the level of risk in my plan or portfolio. So this really actually caused me to think about this. Is it really the services that advisors are offering in these cases, like investment performance and returns, the value? I'm sure that most of you, as competent high-end advisors, are actually giving the right amount of value given the fees that you're charging for your clients. But what may actually be breaking down here is the communication aspect of it. Are you able to communicate the value that you're providing to your clients in a way that they fully understand it? Does that make sense? So it may not be necessarily the value that you're adding, but it's the value that you're communicating to your client that you're adding. So it kind of reminds me of a story. So I'll just kind of pause here to give you a little bit of a story. I've got a friend of mine that is a locksmith. He's been doing this for like 40 years. He has seen every single lock that you can possibly imagine. Homes, cars, businesses, you name it, safes, things like that. And he's gotten to a point where he can actually literally open any lock with really just like one or two little small tools that he carries in his hand. He used to carry around a big toolbox, a big truck, a big van that carried all these tools. He doesn't even need that anymore. So he'll literally go up to, whatever it is that he needs to open. He inserts his tools into his locks, and literally in 5 to 10 seconds, he's got these things open. And it's interesting when you talk to him because he says, look, when I go up and open a door for somebody, of course they're grateful that he provided the service that they asked him for. But when he starts asking them to pay the bill, a lot of people are actually kind of taken aback. They're like, well, why do I need to pay you $500 to open this door? It only took you like 10 seconds to open it up. What they don't actually understand was all the expertise and experience and competence that he's developed over 40 years of doing this that allowed him to open it up in 10 seconds. They simply just didn't see the value of it. So what he actually started to do, and I definitely don't recommend this because this is a little bit of a destructive way to demonstrate value, but what he started doing was just taking longer on his jobs. Instead of opening it up in 10 seconds like he knew he could, he'd start taking, 15, 20, 30 minutes. He'd start breaking locks. He'd start really just demonstrating a big struggle with these locks. And what's interesting is that the clients were still satisfied. They still got into their house, even with a broken lock, and they were more likely to be comfortable paying that $500 bill when they actually saw that he was struggling and they actually knew the value that he was adding to that situation. Does that make sense? So not necessarily a constructive way of demonstrating value, but it resonated with clients. So when I think of this story, I think of advisors and think, well, look, if you're providing these services like investment management, for instance, to your clients, are they really understanding all the knowledge and education and competency and skill and behavioral elements that you're helping them with? Probably not, unless you're explaining it to them in very simple terms. So when it comes time to pay the bill, are they understanding all the value that you're adding for them? In most cases, probably not. And so that's where I think some of the satisfaction gaps are actually happening. It's not that advisors aren't providing the services competently or well, it's that they're not communicating them very well. Does that make sense? So I hope that resonates with you. If anything you got away from this session was that needing to communicate the value in a constructive way to clients to justify the fees, figuring out a way to do so and actually showing them step by step the decision-making processes that you're making and how you're orienting your practices around their needs can go a long way for you. Now, you're not off the hook completely here. It's not just a communication issue. There are legitimate things that you can do and improve to close some of those satisfaction gaps. And that becomes pretty clear to me when I start digging into some of the research like this particular slide. So this slide kind of breaks it down at a service level in terms of what clients expect and how important they think those services are, versus how close that advisor is coming to satisfying those needs, right? So on the left-hand side of the chart, you'll see the stuff that you, again, probably got into the business to do in the first place, like investment management, maybe maximizing income in retirement, portfolio, tax efficiency, that sort of thing. Now, there are satisfaction gaps here for sure. In red, it's really what the clients expect from a satisfaction level, and in blue, that's really what they're ultimately getting from their advisor. But when you start to move from left to right on this chart, those satisfaction gaps get a lot bigger for certain types of services. So when you start talking about transferring assets, right, this big wealth transfer that's going on in a tax-efficient manner, that gap starts to get pretty big. Protecting investments using insurance, for instance, or establishing plans for charitable giving or small business solutions. Those are the areas that clients still value and value very greatly, but their advisors are just simply not providing them at a satisfactory level. So when you think about your own practice, what are the types of services that you need to add to your menu, or at least become more competent in providing for your clients so that you can close some of those satisfaction gaps? And if you're able to do that successfully, I think that goes a long way in being able to, number one, establish those relationships, win and retain more business, I think. Keep those clients stickier, if that makes sense as well. And then also, as wealth is transferred from generation to generation, I think you have a better chance of retaining that wealth over those generations than the person that's not providing these types of services. So this research is actually quite fascinating, and what the biggest takeaway I think is that there are certain types of services and needs that high net worth clients have that they're just simply not getting. Even though they're saying they're satisfied with their advisors, there are bits and pieces here that you can do and do better, and ultimately tell that story better so that you're able to better serve these high net worth clients, because that's really what it's all about, right? There's definitely some benefits for you as an advisor here, but the benefits are, I think, more clear for the clients. And then one just like kind of last point here is that there's a big difference in satisfaction levels between engaged clients and not engaged clients. Now that's going to seem really obvious to you if you think about your own book of clients. The most engaged clients that you have typically tend to be your most valuable, your most sticky, quite frankly, the most profitable, but they tend to be the most satisfied when they're most engaged, right? And that became very clear in the research as well. So when it comes to investment strategies, saving and spending discipline, tax law changes, technical expertise, that sort of thing, there are big ways that you can engage your clients and engage them better so that they become more valuable to you and you become more valuable to them. So I'll just say this kind of lastly, when it comes to demonstrating knowledge, the research was actually pretty clear that advisors do value credentials. Okay, they may not necessarily be able to articulate what they value. They don't know the difference maybe between a CPA and a CFA and a CIMA and a CPWA and a CFP. They wouldn't be able to describe the differences there. but they do value them in the sense that they value that advisors are voluntarily increasing their knowledge and education levels, and they do so through voluntary designations like this. So they do value it. Here are just kind of some stats around who actively sought out an advisor with certain designations, whether they chose to have a relationship with the advisor if they held or didn't hold those designations. High net worth investors in particular really do hold that very importantly. And when you break it down into the type of individuals that value these designations, it's actually quite surprising. This chart kind of tells you who it is that values them the most, and this was actually the opposite of what I would have predicted, by the way. So what this chart kind of says is that the people that value your designations and are very interested in learning what your designations do for them tend to actually skew younger. So people who are younger than 50 years old, 88% of them wanted their advisor to share with them the designations so that they could influence the decision-making process about whether to do business with that client or not, or with that advisor or not. And on the other side of this chart, on the right-hand side of the chart, it was really, quite frankly, the more wealthy clients that valued that designation. So the people that are $5 million and above, almost 80% of them valued those designations greatly, and it influenced their decisions to work with an advisor. So just kind of keep that in mind when you're thinking about the typical prospect that you work with, how much it matters and means to them that you're explaining whatever credentials you have. If you're a CFP, CFA, CPWA, whatever it is, they really are interested in learning what that actually means for them. So that's the research. I hope that was helpful for you. There was a couple of takeaways in there that I think would be useful for you and worth your time. I want to just kind of briefly talk about the CPWA credential and kind of overview the body of knowledge around it and who the typical client would look like that would get the most out of your expertise going through this program. From an advisor perspective, I would say that based on the research, advisors who are CPWAs tend to manage more assets than somebody that doesn't hold this credential. So on average, the assets under management for advisors that hold this credential are higher. The average assets per client of CPWA advisors is higher. It's like 7.3 million on average. Okay, so think about your own average book size. And if this is right in that area, 7.3 million, this is a perfect credential for you. Even if it's not there, the average client size, if you're, maybe 1 million or 2 million or 3 million, but you have plans at some time during your career to serve higher net worth clients, that CPWA credential I think is going to be very meaningful. So if you aspire to having an average client size of 7 million or more, this is a good one to have. The average assets per client of CPWA advisors versus non-CPWA advisors is about 4 times. And so just the 3.9 to be exact. So just want to kind of demonstrate the value of the CPWA by these advisors attracting more valuable clients and ultimately, being able to move the needle in terms of advice for these types of clients. So what is this credential? It's an advanced professional certification for advisors who serve high net worth clients. It's designed for seasoned professionals. So there are some prerequisites, and especially around, experience and other things like that. And it seeks the latest, most advanced knowledge and techniques to address the sophisticated needs of clients with a minimum of net worth of about $5 million. Now, that $5 million is not an exact number here. There are plenty of strategies I'm familiar with in the CPWA program that are perfectly suitable for clients in the $1 million, $2 million, $3 million range. But there are definitely some sophisticated strategies in the program that really are more suitable for the $5, $10, $15, $25 million clients. And unlike credentials that focus specifically on investing or financial planning, the CPWA is definitely more of a comprehensive. It's multidisciplinary. So you're definitely going to see investments. You're definitely going to see estate planning, tax planning, charitable giving, and I'll get into kind of the body of knowledge here in just a moment. So of course the CPWA is a certification, and there is an exam associated with it. This is kind of how the core topics and exam weightings average out. There's 4 parts to the program. I'm going to go through just kind of very briefly and describe what each of these 4 parts are. And I want to just kind of focus on a couple of them here for you. So the first part is really kind of the human element of wealth management. So ethics, of course, is going to be always and in every part of our certifications. It just is what it is, and it's extremely valuable and just definitely needs to be in there. We've included behavioral finance in here, and not just necessarily from an investment perspective, but from a family dynamic perspective. One of the unique needs of high net worth individuals is that a lot of their wealth is tied up, whether it's in a family business or there are family implications to the wealth transfer, often over several generations. And so that really prompts a lot of, I want to say it this way, but it's, advisors often kind of have to act as therapists at times. I bet you, if you think of your own practice, I'm sure you've considered yourself to be therapists at times as well. And high net worth and ultra high net worth families are not exempt from that at all. In fact, wealth usually tends to exacerbate any issues or conflicts that are involved with families. And so this is a real opportunity for you as an advisor to have real strategies to deal with those conflicts. So you're going to learn things like family governance, for instance, methods to getting families together to make decisions, decision-making frameworks and things like that. Real practical stuff that will solve real issues. So that's a very key important part of the program, is kind of the human element. Then I would say that the rest of it is fairly technical. So part 2 is really the technical aspects of wealth management and the strategies that are involved with it. You can see that it's broken down into tax strategies and planning, portfolio management, and then risk management and asset protection. Now, tax strategies, this is an interesting one that comes up, and this is an interesting question that I get quite a bit. And the question is, advisors will say, Devin, I work for a firm like a wirehouse or an RIA that really would prefer I just don't even bring up taxes. By the way, raise your hand if that sounds like you and your firm. They just literally don't want you talking about taxes with your clients because it exposes the firm maybe to a little bit of liability if you're providing tax advice. And most of you, I would say, are probably not CPAs and probably don't have the expertise to provide tax advice, and that's okay. What I would say is that as an advisor, especially to high net worth clients, you do need to provide tax education. Now, there is a difference between tax education and tax advice. Tax education meaning that when you're proposing a range of strategies, let's say you're working with an executive that has, incentive stock options as part of their compensation plan. You're going to be helping them make decisions when it comes to the timing of exercising those options, or maybe, how the proceeds of those options are diversified and so forth when they're sold. But there's big tax issues when it comes to the timing of exercising and selling the stock as a result of those options. So if you're not addressing those tax torpedoes potentially in those client situations, you're not adding as much value as you think. So thinking of it in terms of tax education, I think, is extremely important. And we will definitely hit you up with those taxes. The portfolio management, there are elements of portfolio management that are unique to high net worth investors. There are simply investments that are not suitable for other types of investors, things like private equity, using maybe potentially options, things like that for hedging type strategies, or even borrowing from portfolios, lending type things that high net worth clients have access to that others don't. So portfolio management for high net worth clients is different than the average typical client, and that's a big part of the exam as well. And then finally, risk management and asset protection. This is really what I'm talking about in terms of, the clients that have complex assets, and a lot of assets, they tend to have a little bit of a target on their back. They may get sued because he's rich, or that person's rich. That person might get sued first before somebody that doesn't necessarily have those assets. So how do you protect and title those assets so that they're protected from things like creditors, legislation, lawsuits, things like that? There's a really interesting part of the program there. And then notice that part 3 really breaks things down into different types of clients. Okay, so we've really identified 3 different profiles of the typical high net worth client. There are certainly more to this than these 3, but this is how we've organized the program. I mentioned earlier the executives. So these are the C-suite folks that tend to have pretty complex compensation packages, including options, restricted stock units, things like that. They also potentially have some restrictions in selling and managing those assets that the typical client doesn't have. And so there's a lot of rules there that you really ought to become an expert on. The next type of client that you're probably familiar with that tends to be wealthy is the family business owner, closely held business owner. Their wealth is essentially tied up for the most part within their businesses, and they really struggle with things like liquidity and diversification. They tend to have very concentrated positions. They tend to also have, very unique, distinct personalities as well. And I'm saying that kind of lightly, but they may be a challenge to advise. So really orienting some of this education around these different profiles can really help identify how you question them, how you discover what their needs are, and then ultimately how you examine their needs. And then finally, retirement clients. Almost everyone approaches the retirement age and definitely needs some planning. And high net worth individuals are no exception to that. In fact, they may have more complicated retirement needs because maybe they're divesting their business at that time. They have other objectives like charity and legacy planning that other retirees may not have. So they can definitely benefit from an advisor that's competent in that retirement planning and ultimately being able to pass on as much wealth to their heirs as they possibly can. And then finally, part 4 is that legacy planning. So, setting things up in terms of executing the charitable giving and estate planning and wealth transfer is a big part of this program. Even if you're not necessarily the person, for example, that's executing an estate like trusts and things like that, right? You work with an estate attorney to do that. But giving your client guidance in terms of the trade-offs between one type of trust versus the other can make a big difference and add a lot of value in that client-advisor relationship. So that kind of rounds out the body of knowledge for this credential. I'll just add one quick thing. There's really no other credential, I think, out there that really handles these topics as well as CPWA does. And this is coming from somebody that holds multiple credentials, including, CFA, which is very challenging to achieve. But a lot of this stuff I really never had exposure to in those other designations because when it comes to tax and estate planning and things like that, it's very jurisdictional, meaning that you really ought to have expertise within the U.S. jurisdiction around tax planning and estate planning, as opposed to more of a global type credential. And you need that level of jurisdictional expertise, and very few credentials are capable of providing that. So again, if this is part of your career path, I would strongly encourage you to do that. So that's kind of the body of knowledge I think that's important to understand. Just like every other quality credential, you ought to have an experience, like 5 years or more of relevant experience in the financial industry. You will need to disclose any potential or real violations of the Code of Professional Responsibility, and we do put you through a comprehensive background check. The education piece is important. We provide you with the education through a self-study period. I'll talk about that here in just a second. And then, of course, a stringent examination is required by a third-party testing center. As far as timeline goes, most people prepare to go through this in about 6 to 9 months. Okay, so it takes usually about 2 weeks to apply for it, to get a background check. You've got 6 months to go through the online modules, the online education. You also go through a 1-week executive education program through, like, for instance, the University of Chicago, where you're literally on site in Chicago, hearing from professors from the university and also some practitioners that we bring in to kind of discuss the program as well. And then you kind of study and pass the certification exam from there. I'd like to share this with you more, just kind of some differentiating facts between, say, SEMA, CPWA, RMA. I would imagine most of you or some of you are CFPs, and that's okay. I think about 40% of people that go through CPWA have already earned their CFP credential. So that's why you'll sometimes hear us position it as a post-CFP credential, because it really takes that extra step beyond CFP to be able to handle those high net worth individuals. By the way, you also do earn CFP continuing education credit. So if you're a CFP and you're looking for ways to bang out that 28-hour requirement per year, CPWA will satisfy that in its entirety. And depending on how you time it, I think you can actually get even more than that, get more than a year's worth in there, depending on the timing of that. So that might even be something that you're interested in. So, I kind of talked quickly through that. There are dozens of examples of situations where advisors had gone through the education program, had walked away with, very important strategies, and were able to implement them almost immediately into their practice. The key points here is that it's really key to develop the specialized skills and knowledge that are suitable and applicable to those high net worth clients, and decrease those satisfaction gaps that I was showing you earlier in that research. The other key point is that this is a differentiator from other advisors. CPWA program is growing extremely quickly. It's being adopted by large firms, small firms, independent firms, banks, and trust channels. It really is a way to differentiate yourself from other advisors, particularly if you're able to communicate that effectively to the client that you're pursuing. And of course, this is the way we do it at the Investments in Wealth Institute, but we always strive to include Ivy League education. That's why we work with University of Chicago, Yale, the Wharton School of Business, and others on all of our credentials, but with also practical application. And that's just kind of the way we do it, and I think we do it exceptionally well with these certifications. And then finally, of course, it's to align your services with what high net worth clients need and value, according to the research that we've seen and anecdotally from some of the experiences and stories that we hear from clients and their advisor relationships. So with that being said, here's some information for you to contact. These programs are available. There's an online program through Yale, for instance. There's also the cohort model through the University of Chicago, where you're scheduling time to actually spend time at the University of Chicago. There are enrollment deadlines and things like that you need to be aware of. But the best thing to do is to reach out to us and just have that discussion. We'd like to have that discussion to see if this makes sense for you and if it aligns with the goals that you have and with the objectives that you have with your clients. So I'd like you to reach out to Cheryl Brands. She's the Associate Director of the CPWA programs. This is her contact information here as well. You're also welcome just to reach out to our offices and ask those questions. And frankly, you can reach out to me. I'm happy to share with you my experience going through the program. I went through it in 2016, had a fantastic experience with it, and happy to make that conversation available to you at that time. So with that being said, I'm going to go ahead and wrap this up. If anybody has any questions or anything that they'd like to ask now that I've kind of gone through some of the research and some of the body of knowledge here, I'm happy to answer that question or those questions at this time. I will share, so one quick story here. There was a candidate that went through the program a couple of years ago, and he worked for an investment bank. And he didn't necessarily work with individual clients, but he worked with a lot of like M&A deals. And he was in a situation where he was helping an advisor sell. One of his clients was selling his business. I think in like the $30 to $40 million range was the size of the business that they were looking to sell. So the investment bank was, of course, doing some of the due diligence and investment modeling for that call. So anyway, the situation was that the target company, the client's company that he was selling, was an S corporation, okay, as opposed to a C corporation. The acquiring firm was a C corporation, and the deal was an all stock deal, and they were acquiring 100% of the program, the company. And the C corporation had made a proposal. The S corporation had accepted it, and they were going through the process of valuing the company and ultimately closing the deal. There's a situation, there's a line in the tax code that allows an election to be made in this situation when a C Corp is acquiring an S Corp in a stock deal. And the line in the code says that if this code is elected, then the sale is actually treated as an asset sale as opposed to an all stock sale. And where that actually comes into play is the acquiring company, if they're acquiring the assets, actually receive a step-up basis in the assets at the time of the acquisition. So that when those assets are sold or divested or done something with, the basis for their sale is higher than it normally would be if it were a stock sale. If it were a stock sale, that would be what they call a carryover basis for those assets. And so if the acquiring company sold those assets later, they'd end up paying a big tax bill. So bottom line is that the acquiring company, the C corporation, actually gets a huge benefit when the S corporation elects to treat the sale as an asset sale. And in this deal, the tax savings potentially were around, I think, like $12 million, I think was the number that came about. This candidate, going through the CPWA program, identified that scenario existed in this situation and went to the advisor and says, hey, you know what, the C corporation is asking the S corporation to make this election. They shouldn't just do that without asking for some compensation first, right? So if that's worth $12 million extra dollars to that acquiring company, you should be able to negotiate something else out of the deal to make that election. So the advisor goes back to the client, tells them the situation. Client says, yes, I want to do this. They went back to the acquiring company and negotiated about another $8 million out of the deal. So in other words, the client ended up with $8 million that he wouldn't have otherwise known to ask for because this advisor had that relationship with a CPWA advisor that knew ultimately to make that election. So you can tell how valuable that was to the client. It's certainly valuable to the advisor because that client is now a lifetime client of that advisor. He is never going to give that advisor up. And more importantly, that client's going to go tell all of his other business owner friends that if they're looking to exit their business, he's the advisor that you want because he scraped another $8 million out of that deal. Does that make sense? So that was just an example that stood out to me of content within the program that added immediate value to a situation that advisors were working with. I hope this was helpful for you if you're going through the decision-making process to go through the certification. And I wish you the best of luck. Thanks so much.